Economic collapse refers to a sudden and severe downturn in a country's financial system, often resulting in widespread unemployment, loss of savings, and disruption of essential services. Understanding how such collapses unfold is crucial, as it allows individuals, businesses, and governments to prepare and respond effectively. By examining the progression of economic decline, we can identify warning signs and potential triggers. This knowledge helps mitigate risks and supports the development of strategies to safeguard stability during turbulent times. Economic collapse refers to a sudden and severe downturn in a country's financial and productive systems, often resulting in widespread unemployment, loss of income, and a breakdown of normal economic activity. Key indicators of economic collapse include hyperinflation, a sharp decline in gross domestic product, soaring unemployment rates, and a rapid fall in currency value. Historically, events such as the Great Depression of the 1930s and the collapse of the Soviet Union in the early 1990s serve as prominent examples. These periods were marked by significant disruptions to daily life and long-lasting impacts on both national and global economies. Understanding these indicators and historical precedents helps to clarify the profound effects that economic collapse can have on societies. Several early warning signs can indicate potential trouble in the economy. Rising inflation often leads to higher prices for everyday goods and services, reducing purchasing power for consumers. At the same time, increasing unemployment suggests that businesses may be struggling, resulting in fewer job opportunities. Declining consumer confidence reflects growing uncertainty about the future, which can lead to reduced spending and investment. Together, these factors may signal the onset of economic challenges ahead. During the initial stages of a financial collapse, institutions and markets often experience heightened volatility and uncertainty. Banks may tighten lending standards, restricting access to credit for businesses and individuals. Stock markets can see rapid declines in asset values as investors rush to sell off holdings, seeking safer alternatives. Trading volumes typically surge, and liquidity may become scarce, making it harder to buy or sell assets at stable prices. These reactions reflect widespread concern about the stability of the financial system and can further amplify the crisis. Businesses faced significant challenges during this period, with many forced to close their doors either temporarily or permanently. Widespread layoffs resulted in a sharp increase in unemployment, affecting workers across various industries. Supply chain disruptions further complicated operations, leading to shortages of essential materials and delays in production. These combined factors created a ripple effect, influencing not only individual companies, but also the broader economy. The consequences of these disruptions continue to shape business strategies and recovery efforts today. Economic downturns can have profound effects on everyday people. Many individuals may experience a loss of savings as financial institutions struggle or fail, eroding hard-earned funds. Reduced access to goods becomes a reality as supply chains are disrupted and prices rise, making basic necessities less affordable. These changes often force families to alter their daily routines, cut back on spending, and adapt to new challenges in managing household budgets. The ripple effects can touch nearly every aspect of life, from employment opportunities to personal well-being. In response to the crisis, governments around the world implemented a range of emergency measures aimed at stabilizing economies and protecting public health. Stimulus packages were introduced to support businesses, safeguard jobs, and provide financial relief to individuals and families. These interventions often included direct payments, expanded unemployment benefits, and loans for struggling sectors. Additionally, policy shifts were made to adapt regulations and ensure the continued delivery of essential services. Together, these actions reflected the urgent need for coordinated government efforts during unprecedented times. Rising social unrest has become a notable consequence, often manifesting in protests and heightened tensions within communities. These conditions can prompt increased migration, as individuals and families seek stability and better opportunities elsewhere. Additionally, shifts in public trust are evident, with many people expressing skepticism toward institutions and leadership. Such changes can have lasting impacts on the fabric of society, influencing both policy decisions and everyday interactions. Long-term outcomes following a major disruption can vary significantly. Some regions or organizations may experience a period of recovery, gradually returning to stability and normal operations. Others might undergo substantial restructuring, adapting their systems and processes to better withstand future challenges. In certain cases, prolonged instability may persist, with ongoing uncertainty and difficulties that hinder progress. The trajectory often depends on the underlying causes, the effectiveness of interventions, and the resilience of those affected. Reflecting on the lessons from past societal collapses, it becomes clear that adaptability, resource management, and social cohesion are crucial for long-term stability. History shows that societies which recognize warning signs and respond proactively are better equipped to withstand challenges. Investing in education, fostering open communication, and building resilient infrastructure can help communities prepare for future uncertainties. By learning from previous failures, societies can develop strategies to mitigate risks and promote sustainable growth. Ultimately, a commitment to continuous improvement and collaboration offers the best chance for enduring success. Thank you for joining us for this presentation. We hope you found the information helpful and engaging. Your support is greatly appreciated, and we look forward to sharing more content with you in the future.